Two people each put $7,500 into an IRA every year for 30 years. Same fund, same return, same account balance at retirement. One walks out with $432,000 more than the other, and the one who won might surprise you. That gap has nothing to do with picking better stocks or timing the market. It comes down to one decision most people make in about 45 seconds on an enrollment form without running a single number. Let's run the numbers right now. Here is the setup. You are 35 years old. You earn $75,000 a year. You are in the 22% federal tax bracket. The 2026 IRA contribution limit is $7,500. That is up $500 from last year, confirmed by the IRS in Notice 2025-67. You are going to max it every year for 30 years into a low-cost S&P 500 index fund averaging 8% annually. You retire at 65. That is the scenario. Now let us run both paths. You put in $7,500 per year. Because traditional IRA contributions are pre-tax and tax-deductible at your income level, that $7,500 only actually costs you $5,850 in real take-home dollars. The difference, $1,650, is tax you did not pay this year. Think of it as the government co-investing $1,650 alongside you every single year. That is a meaningful upfront advantage. The account grows tax-deferred for 30 years. Compounded at 8% annually, $7,500 per year for 30 years grows to approximately $918,000. That is your balance at retirement. But here is the important detail. Every single dollar in that account is pre-tax money. You have never paid tax on any of it. Not the contributions, not the growth, not $1, and the IRS has not forgotten. You also put in $7,500 per year. But this time, it comes from after-tax dollars. There is no immediate deduction. That $7,500 costs you the full $7,500 out of your take-home pay. That stings a little more each month. The account also grows for 30 years at 8% annually and arrives at approximately $918,000. Identical balance. But here is what is different. Every single dollar in that account has already been taxed. The contributions, the decades of compounding growth, all of it. When you pull money out in retirement, the IRS gets nothing, not a dollar, not ever. So on paper, both accounts have $918,000. Most people look at those two identical numbers and think this is a coin flip. Higher tax rate now means Roth wins. Lower tax rate in retirement means traditional wins. They pick one, move on, and never think about it again. That is exactly where the $432,000 gap gets created. But here is what most people missed. The $432,000 is not in the account balance. It is in what you actually get to spend. And those are two very different numbers. Let us say you are in the 22% bracket today, and you expect to be in roughly the 22% bracket in retirement. Both accounts earn 8%. Both hit $918,000. Conventional wisdom says they are equal. Here is why that is mathematically wrong, and why it costs people hundreds of thousands of dollars. With the traditional IRA, your $918,000 is all pre-tax. Every withdrawal you make is treated as ordinary income by the heirs. If you pull $60,000 per year in retirement, not an unusual number for a comfortable retirement, you will pay somewhere between 13% and 15% effective federal tax on that. That works out to roughly $8,000 to $9,000 per year in federal taxes. Over a 15-year retirement, that is between $120,000 and $135,000 paid directly to the IRS from your retirement savings. money that went into your account and never came out into your pocket. With the Roth, that same $60,000 withdrawal is completely tax-free. $0 in federal taxes. Every dollar you pull out is yours to spend. Now let us layer in Social Security, because this is where the traditional IRA quietly gets even more expensive. Traditional IRA withdrawals count toward what the IRS calls your provisional income, the formula used to determine how much of your Social Security benefit is taxable. Here is how it works. If your combined income as a single filer crosses $25,000, up to 50% of your Social Security becomes taxable. Cross $34,000, and up to 85% becomes taxable. For married filers, the thresholds are $32,000 and $44,000. Roth IRA withdrawals do not count toward provisional income at all. 0. They are completely excluded from that calculation. Here is what that means in practice. Say you are drawing $25,000 per year in Social Security. Your traditional IRA withdrawals push your provisional income well above $34,000, so 85% of that $25,000 or $21,250 becomes taxable income. At a 15% effective rate, that is an extra $3,187 in federal taxes every single year, just from that one interaction. Over 15 years of retirement, approximately $47,800 in additional taxes, paid entirely because you chose the traditional. With the Roth, that $25,000 in Social Security stays largely untaxed because your Roth withdrawals do not push you over any threshold. Add everything up: the annual taxes on withdrawals, the Social Security interaction, the compounding effect of those extra dollars left in the account, and the Roth can deliver somewhere between $200,000 and $432,000 more in actual spendable retirement income. Not more in balance. More in money you actually get to use. Same account balance. Same investment return. Same tax bracket. The entire gap comes from when the tax is paid and what that timing triggers downstream. And there is one more advantage the Roth has that has absolutely nothing to do with your tax bracket in retirement or right now. It is a rule that quietly forces millions of Americans to take money out of their account, whether they want to or not. Required minimum distributions. Starting at age 73, the current threshold under Secure 2.0. For most people, the IRS forces you to withdraw a minimum amount from your traditional IRA every single year, whether you need the income or not, whether the market is up or down, whether pulling the money is convenient or painful. The formula is based on your account balance divided by your IRS life expectancy factor. On a $900,000 traditional IRA balance at age 73, your first RMD is roughly $34,000 to $36,000. That amount lands on your tax return as ordinary income. It could push you into a higher federal bracket. It adds to the provisional income calculation that taxes your Social Security. And critically, it can trigger IRMAA, the income-related monthly adjustment amount, which is Medicare's premium surcharge for people whose income crosses certain thresholds. In 2026, IRMAA kicks in for single filers with income above $103,000 and married filers above $206,000. The surcharges range from approximately $70 extra per month all the way to more than $440 extra per month for the highest income tiers. Over a full year, that is $840 to $5,280 in additional Medicare costs triggered not by something you chose to do, but by a government-mandated withdrawal from an account you may not have needed to touch at all. The Roth IRA has no required minimum distributions during your lifetime. None. The money can keep compounding tax-free for as long as you are alive. If you do not need it at 73, you do not take it. If you want to leave the entire balance to your children, it passes to them tax-free, though under current Secure 2.0 rules, your non-spouse heirs will need to deplete the inherited Roth within 10 years. This is what retirement planners call the invisible tax on the traditional IRA. The account builds quietly for decades and does not feel expensive at all. Then, at 73, the IRS starts pulling the strings on your withdrawal schedule, and the compounding cost of those forced withdrawals starts working against everything you built. To be fully honest, the traditional IRA is the correct choice in several real, specific scenarios. This is not a one-size-fits-all answer. Scenario 1. You are currently in the 32% or 37% federal bracket, and you genuinely expect to drop into the 12% bracket in retirement. Maybe you are planning to retire early with low fixed expenses. Maybe you have a paid-off house, modest Social Security, and minimal other income sources. If you defer taxes at 32% today and pay them at 12% later, that is a 20 percentage point arbitrage and over 30 years of contributions. That gap compounds into a very large number that legitimately favors the traditional. Scenario 2. You are closer to retirement, say, within 10 to 15 years, and the Roth's compounding advantage does not have enough time to fully offset the upfront cost of contributing after-tax dollars. The math compresses significantly when the time horizon shrinks. A 58-year-old with 7 years to retirement is in a very different position than a 35-year-old with 30 years of compounding ahead. Scenario 3. You genuinely need the deduction today. If the saying $650 in annual tax savings is the difference between maxing your IRA and not being able to afford to contribute at all. The traditional's immediate cash flow benefit has real and tangible value. A partial Roth contribution funded by a smaller traditional deduction is still better than nothing. The key is that none of these decisions should be made by guessing. They should be made by running your actual numbers against your specific bracket, expected retirement income, Social Security estimate, and state tax picture. And here is the scenario almost nobody prepares for, the one that makes most people wish, 30 years too late, that they had chosen differently. The Roth IRA wins most decisively in one situation that has nothing to do with your current or future tax bracket. It wins when retirement income from multiple sources, Social Security, RMDs, part-time work, investment income, pension all pile up simultaneously and push you into unexpected territory. Most people build their retirement plan around a single income source at a time. They look at their IRA in isolation. But in practice, a 73-year-old might be receiving $28,000 from Social Security, $35,000 from a required minimum distribution they did not want to take, $12,000 from dividend income, and $15,000 from part-time consulting. That is $90,000 in combined income, and in that environment, the traditional IRA SRMD is not just taxed on its own. It is taxed in the context of everything else, at the highest applicable rate across the full picture. The Roth IRA withdrawal in that same situation adds nothing to taxable income. It does not push Social Security into the 85% taxable zone. It does not trigger IRMAA surcharges. It does not compound the effective rate on every other income source. It is simply tax-free and in a retirement with multiple income streams that is worth significantly more than the original bracket comparison suggested. One more note worth flagging in 2026 specifically. If this video helped you see the real math on a decision most people are guessing at, every week we do exactly this: take the financial decisions that feel complicated and show you what the numbers actually say.